I do like to start off the week every time with a summary of what I saw happening for the market this week. And here's a chart of the S&P 500 year to date. You can see, that red line is kind of showing across the tops there. We're still in a down market. The blue line is the 200-day moving average. And what we've had, though, is a really good run up from, right where I'm sitting here, basically the bottom of October to now. And we even got through the 200-day moving average last week. Chairman Powell was talking at the Brookings Institute. The market thought that what he was saying sounded good, apparently, and the market moved up quite strongly based on that. So we have taken that back now as far as that goes. But there's some really important things happening right now that are quite different than they were even just a few weeks ago. And so one of the things I'll share with you here is just, this is the Spyder S&P 500 ETF SPY. I'm just showing the part of the run up here that we've had since the middle of October. And I'm using a line chart here because the line shows closing prices. And so I've drawn a nice little blue trend line there. So you can see we're holding this trend line so far. We're continuing to kind of march up, and we jumped through the 200-day moving average, but we didn't quite get through that red, trending down line. If I change this chart, same time frame, to candlestick chart, you can kind of see more of what was going on because candlesticks show the intraday activity also. And so you see that big green piece where we hit the bottom back in the middle of October, right? I mean, that was a huge turnaround day, and we've catapulted off of that all the way through. And then if you look most recently, the last 3 or 4 days here, we've been kind of bouncing off of this trend line, so we're kind of challenging it. But if you look, last week, we got all the way up to that red trend line that we've been trying to break through. So in classic, technical analysis terms, a downward trend is a series of lower highs, right? So that's what that red line is showing. And there are several different things that you can say that would happen to create that trend in the other direction. So our primary trend right now is down. How do we get to a primary uptrend? Number one, get through the 200-day moving average, which we did for a couple days, and then it came back. Number two, get through that red line, break the trend, stay above that. And then the last one really is just setting up a new high that isn't lower than the previous lows, previous highs. So what's fascinating, though, here is if you look, that red line, there's going to be a lot of selling there. That's why we got there that one day, right, and sold. Because there's a lot of technical analysis programs and people and managers that have short selling, orders in at that red line or someplace close to it. So there's selling there. Now look at the blue line. The blue line on the bottom is showing, higher lows. That's a temporary, at least at the moment, uptrend. And so there's buying on the blue line. But if you notice what's happening now, they're converging. And so something's going to happen here.
So, yeah, this is a pretty classic triangle pattern.
Yeah.
And so either you break up or you break to the downside. And so that's usually, once you have this break, it's a pretty dramatic one.
Exactly. And so, which way will it be, right? I mean, there's a couple things here. Number one is we are kind of bouncing off the lower one. We're eating up some of that buying on the blue line. So that's a little concerning. Rather be closer to the red line. But it's also not moving that much in the last 3 days. Next week is very significant because on Tuesday we get the CPI report, and so we'll see what inflation was. If you remember last month, it was a huge surprise. Market jumped way up, and because it went to 7.75%. The Cleveland Fed does a projection for the CPI each month. Right now they have it at 7.49. Which would be a nice drop from 7.75. Still very high, but really at this point, we're just hoping for direction, right? Continue to see it coming down. And so we'll see. Maybe the market jumps again and gets through that red line based on a better CPI report. Maybe it's the opposite and it falls through that blue line. So we're all kind of in a waiting mode right now, and you can see what's going on and kind of how this thing is being pinched.
Yeah, the market's looking for kind of that confirmation. Is it a confirmation that we're in a good trend, we're going downward, we have 2 months in a row that inflation's going down, or was it just kind of a false positive?
Yeah, I mean, we break through that red line with some power for whatever that reason might be. We could be on our way to a new positive trend here that could hold up for a while. It'll be nice to hit another new, get above the high that we had in August, for example, those types of things. But we break below that blue line, we could go back down and set up a new low below where we were in October. So right now we have 75% of our allocation, our normal allocation to stocks in the market, in the S&P 500 and the total stock market index, specifically our two bigger holdings. But what we're looking at there, and the reason we're not 100% is because of this pinch. It depends on which way this goes. If it breaks down, we probably should get some more conservative and pull some of that off the table, just because it could really go down quite a bit. If it breaks up, we'll probably get back to 100% of our allocation, that type of thing. So we're right there. We're right at this little crux spot as far as that goes. There was a report today on inflation. This is the Producer's Price Index, and it was a little bit higher than expected. And so the market actually dropped a little bit on this because the market is moving on expectations, and when those expectations aren't met, it readjusts one way or another. However, if you look at the actual trend for the Producer Price Index, it was 11.7% back in March, and now it's 7.4%. 7.4 is still too high, but the trend at least is what we want to see there as far as that goes. So I really think that one of the things we've got to keep focusing on here is what's happening with inflation, especially here for the short term until we get these reports, until we hear from the Fed next week. But I do think there'll be some shifting going on. And here's another inflationary number that just came out yesterday. So last Friday, the federal government put out the jobs report, and it showed hotter job market than thought, right? 263,000 jobs instead of 200,000 jobs created. And the wage growth was really twice as much as expected. And that's why we've come down from kind of challenging that, red line. But this one is very fascinating. This just came out yesterday. So it's in Bloomberg. This is Indeed, which is the company where you can, list jobs if you're looking for employees. And they put out a report showing the annual wage growth year over year on the job listing. So their point was our report is maybe showing the future because these are jobs that are being listed now. The government is reporting what people are actually getting paid, which might be a little bit of a lagging indicator. So this would be interesting. What they did say about this report was that we would get back down, if we follow this trend the way it's going now, we would get that back down into that 3-4% annual increase in wages by the second half of next year, which is where we were before the pandemic started. So this is a big deal because a big part of inflation really comes from wages.
Yeah, would there be any difference in the job postings versus the Fed's report? Because Indeed only probably posts a certain amount of jobs. Would there be any kind of difference in data?
Well, they're both, probably a sampling, right? I mean, the Fed isn't every job either. In that job report, it's a sampling survey-based, report. This has, I've forgotten how many jobs they analyzed for this, and they broke it down into categories. So, I mean, they both have probably their downfalls, as far as that goes. But I still think it's very fascinating, just this gut feel that inflation is getting better and better, and the market. And one of the things you can see here too, this is the yield on the 2-year Treasury, right? So what the 2-year Treasury will pay, and it's going back. And I've drawn these two parallel blue lines there. That was the big rally we had in the summer. Middle of June, July, ended up ending middle of August. About an 18% run. You can see the yield went sideways, but it was moving upward right at the top, and eventually it broke out of that range, and the market collapsed, and we went all the way back down to a new low in the middle of October. So then we got this other channel up here on top, where we've been moving since now the middle of October, kind of coming up. And you can see there, we're definitely softer in that channel right now. And, maybe the overall trend line right there, that we call that a descending triangle, actually. So that could break up or down. We'll have to wait and see what happens. But when you see the 2-year Treasury yield coming down, that likely means that the Federal Reserve, at least from the bond market's perspective, will be slowing rate hikes or stopping rate hikes, or even eventually, lowering rates as far as that goes. And the bond market is really, really good at predicting where the Federal Reserve is going to end up going, more so than they are. The bond market has been more accurate at figuring out where the Fed is going to go than the Fed has been figuring out where they're going to go. So anyway, so this is why we watch this so closely. This is a good sign, right? However, one of the reasons that the yield can drop is because of a recession.
Yeah, because if people are worried about the market, Fed is going. If something breaks in the market, Fed has to step in and lower rates.
That's exactly right. So if you start to see, unemployment jumping dramatically, that's one of the Fed's other criteria is to try to keep full employment. Maybe they start to lower rates, and and there's things that are going on probably in the economy that aren't helping earnings at that point in time. And so my key point here now, in my opinion, is the market has been obsessed with inflation, right? And rightfully so. But I think because we're starting to see inflation kind of peak, and hopefully it keeps coming down, and because we're seeing the direction of inflation, I think inflation as a driver for the stock market is less than it was. I think the main driver now, and the thing to really focus on, is recession, right? Because that's the big thing. We've seen all of these flashing red light signals saying recession next year. I mean, there's just so many. The inverted yield curve, the leading economic indicators, et cetera, et cetera. There's a fairly good chance we have a recession, but how bad will that be? And more importantly, how much does that impact earnings, right? And so this is a pretty cool chart that shows in all the recessions since 1957 what happened to the S&P 500 during the recession. So once the recession is called to when it ends, what was the rate of return? So it might have dropped or gained before, or what have you, but just right in the recession themselves. So if we're worried about a recession, what happened in the past is something useful. The average return is actually negative 1.5%. So that's pretty interesting. And there's a whole bunch here where it actually went up. However, if we look at kind of the time frames that are more like what we have now, nothing's exactly like what we have now because none of these include a pandemic.
Yeah.
But 1973, it was down 18%. 1980 was another high inflationary period. It actually went up 16%. And then in 2000, we had this bubble type mania, sort of like we've had here in 2020, 2021, and it was down 7%. So, it's a little bit of a mixed bag as to where we might be as far as that goes. But honestly, if we drop 7% more from where we are, and that was it during that entire recessionary period that we might have next year,
that's not too bad.
Yeah, that'd be pretty doable, right? I mean, especially because there's a silver lining here. I know there's a lot of numbers here, but what they're showing here, and this is again from Invesco, is the first column shows the rate of return for the S&P 500 in the last 3 months of the recession. And it's 12.9%, which is fantastic, right? 3 months, 12.9%. The 1 year after the recession ends is 15.3% average. 3 years is 40.1%, and 5 years is 78.7%. So this is the key. This is the silver lining. If we can get through this, if we can preserve capital, if we can buy back in at the right times, all the things that you might do, just hold on, whatever it is, whatever your strategy is, once things kind of get through, then things can take off. And here's why. Right now, there's a misallocation of capital that's been going on from 2020 and 2021. The whole cryptocurrency thing, what did it get to, like $3 trillion, right? That's money that should have been going to Apple or, a company that had actual earnings. It's now down to 800 billion. So what we're doing is we're squishing out some of these things, these IPOs, the companies that didn't have a product yet or didn't have earnings, didn't have revenue, and yet they're worth $100 billion or so, crazy numbers like we saw, very much like what we saw in 2000. And the SPACs, remember the SPACs?
Yeah.
Colin Kaepernick was going to have a SPAC, right? I mean, that's too much money floating around looking for things to do. And so that's all now being squished out. And one of the reasons why you see something like the S&P 500 like this doing so well in the recovery from a recession is because people start to get back and focused with the things like the quality companies you'd see on the S&P 500. So this is a necessary environment. You get that expansion, contraction that happens in the economy, and the contraction, theoretically wipes out some of the weak players and some of the players that shouldn't be in there, and capital gets allocated in a more efficient manner. And boy, you can really take advantage of that and gain from what happens afterward. So that's what we're looking forward to. Hopefully next year, could be we've already hit our low in October, right? Who knows?
Yeah, and you can see in this chart too, it's saying the S&P has a positive return 3 months before the recession's actually declared over.
Yeah.
And so that's showing that the market is forward predicting, and so it predicts positive return prior to the actual recession ending.
Oh, it's a great. I remember my grandmother saying to me, we're in the middle of a recession and all kinds of people are losing their jobs and the stock market's going up. Why? This is exactly why, because the stock market's looking at the next phase, which is past the recession and past all of the layoffs. Layoffs tend to be lagging indicator, right? It takes a long time to figure out who to lay off. And so, yeah, you'll probably find that the bottom, if we have one, is kind of a dark time. It's just nobody's really excited about what's going on. And again, the market is that forward-looking mechanism as far as that goes. And here's a couple of things that I think we should focus on as possible scenarios that help to soften a recession. So if we're going to have a recession next year, and the indicators are saying we should, but how deep it is now the question. Does it really impact earnings? And so number one, this is a chart of the iShares China index. So this is the China stock market essentially. And you can see we've had a huge run up here just recently. And what's happened is that first it was kind of a rumor about the zero COVID, policy starting to soften, and then actually happening. Now there are softening the zero COVID policies. And that's a really big deal. We'll have to see if it works, because if everybody ends up in the hospital and they go back, we'll see how this plays out. But there's two big things here. Number one is reopening China allows the supply chain to get better worldwide, because they're the biggest portion of the supply chain. Number two is they are the second largest economy in the world. They've been underperforming because of zero COVID. And if they start to perform at average, that could be a lot of money being spent.
They're a big consumer of luxury goods for a lot of companies.
Yeah, and now that could also be inflationary, which if they get going really hot, so that could cause some issues too. But in terms of softening a possible recession next year, this is a counter trend to that, right? Yes, the U.S. could end up in recession, but China could start to really boom because they're finally kind of getting out of this scenario that is tough to really have a vibrant economy in when everybody's locked down so tightly. So that's one. Number two, and the last piece here, is the consumer spending. This goes back to 2010. This is in real dollars, so after inflation, so it's still going up, and you can see the dip there that happened in 2020. But still, consumers are still spending and spending and spending. We had, all kinds of different reasons for them to cut back. And this is one of my key points, is that all of the data that we look at in past recessions and how much the stock market dropped and how much earnings dropped did not include a pandemic with a pent-up demand. So if you look, the yellow line is the services. That's your restaurants, your movies, your hotels, your air flights, all those things. That's gone up very significantly, actually. If you look at the goods, the blue line, it didn't dip much in 2020 because that's what we were doing. We were ordering Amazon and ordering,
Everyone's
kitchen
getting
remodels.
their Pelotons. And
and now that's starting to drop. See that? So we're probably going to see less inflation in goods, and possibly even some deflation in goods for some of the hard goods like big screen TVs or whatever it might be. And we're going to continue to see inflation in the service area. That's a bit of a problem for the Federal Reserve in terms of trying to slow things down, but it also softens a recession. If the pent-up demand continues to go, because, look, at one point in time, nobody could do anything. Even if you wanted to spend money on services, you couldn't, because the airlines were closed down, the movie theaters were closed down. And then they opened up. And so the first group that comes out, they weren't afraid of the virus in the first place. But there's still people coming out and coming out and coming out and doing more and more things. And we're just seeing, I think, a continuation of that motion, of that pent-up demand continuing to come out. Now, that is going to cause problems for the Fed, and inflation might rear back up again as an issue, and maybe it doesn't continue down. It has so far, even though the demand is picking up, so we'll see how that plays out. But certainly, this is something where the earnings for these companies could continue to hold in there and not have that huge drop-off like we did in 2008, where earnings came down so much. And I've always liked to say this last piece, the S&P 500, for example, is full of companies that are unbelievably good at managing their earnings, right? And in an environment where there's still people spending, they're going to find a way to manage their costs, keep their revenues, in the right place, and be able to maybe still push through a great earnings per share that people aren't expecting. The last earnings that came out here in the fourth quarter were better than expected. And still lower, right? I mean, they've been coming down, but still better than expected, and really kind of was part of the catalyst for the run-up that we've had so far since this middle of October timeframe was earnings. So earnings will be a big deal first quarter of next year, and second quarter for that matter. But anyway, so that's what's going on. That's our kind of summary outlook of what we see happening in the market. We haven't been on in a couple of weeks, so I wanted to spend a little bit more time on it just to kind of emphasize what we're seeing. So look forward to being able to talk to you again next week and show you, what we've got going on.